Okay, exercise 2. Once again, this is a homework one. Oh gosh, excuse me. All right, adding company signs a lease agreement dated January 1st of 2019 that provides for it to lease non-specialized heavy equipment from Scott Rental Company beginning January 1st of 2019. The lease terms, provisions, and related events are as follows. Lease term is 4 years. Lease is non-cancelable and requires annual rental payments of $20,000 to be paid in advance at the beginning of each year. Okay, let's look at some of this stuff as we go. The cost and also fair value of the heavy equipment to Scott at the inception of the lease is $68,036.62. The equipment has an estimated life of 4 years and has a 0 estimated residual value at the end of this time. Okay, so right here, I think that's number 3, right? So 3 is going to be yes, because term of lease equals life of asset. So that's a major part of it. So honestly, I could quit doing these things, but we'll look at it. Adden agrees to pay all executive costs directly to a third party. Lease contains no renewal or bargain purchase options. Scott's interest rate implicit in the lease is 12%. Adden is aware of this rate, which is equal to its borrowing rate. Okay, so the other thing I could do is take the $20,000 in payments times the present value factor for an annuity due. To be paid in advance, yeah, for an annuity due at 12%. Okay, 4 years at 12%. I'm not going to go back to that table. You would go back to that present value of an annuity due. 12%, 4 years. And the factor is, where's this one? So 4, you would do the 20,000 times a factor of 3.401831. $20,000 times 3.401831, and it equals the 6. I did something wrong there. Missing a 0, and it equals the fair value. Okay. So number 4 is yes as well. So yes to number 4. All right. So since it meets at least one of them, it actually meets 2. This is a finance lease to the lessee. All right, then we're supposed to do a table summarizing the lease payments and interest expense for added. Okay, so let me set the table up, and then we'll come back and look at it. Okay, so I have it set up. So we have the date, the annual lease payment, the interest, and the balance on the lease liability. So the lease liability starts out at the $68,036.60, and then our first payment is $20,000, and we take it directly off. All right, and then I calculate my interest at December 31st. I calculate my interest, and it's my balance times the 12%. So this is balance times the interest rate. All right, and then that gets added to the lease liability. So it's the 48 plus the 57. Okay. Then it's 1/1/2020. I make a $20,000 payment. That comes off of the balance, so 53 minus the 20. Then at 12/31/2020, I have interest again. So it's my balance times the 12%. And I add that to it. And 1/1/2021, I make another $20,000 payment. That comes off my balance. Then 12/31/2021, I charge interest. So it's my balance times 12%. That adds to my balance. And this should be $20,000. Okay, so my interest needs to be a little bit more. Maybe more cents. And then 1/1/2022, I make my final $20,000 payment, and it comes off my balance, and I'm done. Okay, but let's make it all dollars so we can make sure. Yep. All right, so all I did here at the end is I just added 4 cents to it to make it balance out right. Okay. Prepare the entries for add-in for the years 2019 and 2020. Okay, so actually what I'm going to do is I'm going to come over here and do them where we can see our table. So first off, we bought the asset. So we're going to have the right of use asset and a lease liability. I don't know why that's looking like that. And they are going to be for the 68,036.62. I'm going to make this big for the moment. All right. Then also at 1/1, I'm going to pay $20,000. So it's going to come off my lease liability and cash out the door for $20. All right. Then at 12/31, I need to accrue this interest right here. All right, so I'm going to have interest expense. And I'm just going to add to the lease liability. So remember, instead of crediting interest payable, we're going to credit the lease liability. And it's going to be for the $57.64.39. All right, and then also at 12/31, I need to amortize the asset. So I'm going to have amortization expense, and it comes right off of the right of use asset. And we're using straight line, so it's going to be the 68,036.60 divided by the 4-year term. And then finally, if you remember, not finally for 2019, we also paid executory costs. We paid insurance and property taxes. All right, so insurance was $1,500, property taxes were $5,000. So I'm going to have 12/31/2019. I'm going to have insurance expense, property tax expense, and cash out the door. All right, my insurance expense was I don't remember what it was, 1,500, 5,500, and then cash is going to be the two added together. All right, so those are my entries for 2019. All right, and this interest right here came from right here. All right, then for 2020, I'm going to do the same thing. Just these. I don't do the first one. This is where I initially entered the lease. But I'm going to have all these same basic entries. So actually, I'm just going to copy them because they're all basically the same. All right, I'm going to have 1/1/2020. (12/31/2020). Okay, so the first one is the same. This one, however, needs to change. Okay, and if you remember, it needs to come from this over here. Okay, the interest over here for 2020. So 405,612. All right, the amortization expense stays the same, and then they tell us what that should be, and it should be 1,300 and 6,000. And that's it. That's what we're supposed to do.